Asalam-o-Alikum in international economics class. Our today topic is theories of exchange rate. As we already discussed what is exchange rate, what is the basic concept of the exchange rate. Now we will discuss some theories of exchange rate. So at the most basic level, exchange rates are determined by the demand and supply of one currency relative to the demand and supply of another. However, differences in relative demand and supply explain the determination of exchange rate. They do not they do it only in a superficial sense. Prices and exchange rate. To understand prices are related to exchange rate movement, we first need to discuss an economic proposition known as the law of one price. Then we will discuss the theory of purchasing per parity, which links changes in the exchange rate between two countries' currencies to change in the country's price level. Law of one price. The law of one price states that in the absence of trade friction and under condition of free competition and price flexibility, identical goods sold in different locations must sell for the same price when prices are expressed in a common currency. So, what is arbitrage? Arbitrage क्या है? Arbitrage is a financial strategy that involves simultaneous buying and selling of an asset in different markets to capitalize on price discrepancies, facilitating a risk-free profit. Example के जरिए उसके देख लेते हैं. Let's suppose there is a trader who discover that gold price in the UK are lower than the US. The trader could buy gold in the UK and sell it simultaneously in the US, making a profit. Obviously, एक ट्रेडर अपने प्रॉफिट को देख के ही ट्रेड करेगा. तो अगर उसको यूके में कम प्राइसेस पर मिल रही है तो वो यूएस में ज्यादा प्राइसेस पर बेचकर अपना प्रॉफिट जो है वो कमाएगा. So the existence of arbitrages in market drive prices closer, maintaining the law of one price. तो क्या होगा? मार्केट फोर्सेस क्या करेंगे? जो प्राइसेस है उनको इतना क्लोज करेंगी एक दूसरे के साथ कि वो जो लॉ ऑफ वन प्राइस की जो लॉ है उसको इम्प्लीमेंट करने के लिए वो प्राइसेस के ऊपर वर्कआउट करेगी. एक कंट्री अपना प्राइस थोड़ा कम करेगी, दूसरा थोड़ा ज़्यादा करेगी, तो उसमें मेंटेनेंस आएगा और उसकी वजह से जो प्रॉफिट है ट्रेडर का वो कम होगा या ख़त्म होगा. However, arbitrage is not always possible और ये तो possible ही नहीं है due to various constraint. और constraint कौन-कौन से हैं? Like transaction cost, trade barriers and differing tax structure. So because of all these constraint जो एक ट्रेडर है वो इजीली अपना प्रॉफिट जो है वो अर्न कर सकता है. To truly understand the relationship between these concepts, the impact of friction cost come into play. Those costs that make prices diverge: transaction fee, transportation costs, taxes, and tariff. So the second theory is purchasing per parity. In this theory, we have two types. Number one is absolute, and the second one is relative. We will discuss both of them one by one. So, what is the absolute version of the PPP theory? If the law of one price were true for all goods and services, the PPP exchange rate could be found from any individual set of prices. By comparing the prices of identical product in different currencies, it would be possible to determine the real or PPP exchange rate that would exist if market were efficient. So, a less extreme version of the PPP theory states that a given relatively efficient market, that is market in which few impediments to international trade exist, the price of a basket of goods should be roughly equivalent in each country. To express the PPP theory in symbols, let price of the dollar in the US of a basket of particular goods should be the same in the Japan. For the same basket of goods in Japan yen, the price, the PPP theory predict that the dollar by yuan exchange rate should be equivalent to price of dollar divided by price of yuan. So what is the example, or we try to understand the through example. If the basket of a goods cost is $200 in the United States and 20,000 in the Japan yen, the PPP theory predicts that the dollar by yuan exchange rate should be 200 divided by 20,000, or we can say $1 equals to 100 yuan. यानी कि सेम बास्केट जो है वो सेम बास्केट ऑफ गुड्स यूएस $1 पे करके लेता है जबकि जापान 100 yuan को पे करके लेता है. So this is what the exchange rate is, or the absolute version. So purchasing par parity relative form. The next step in the PPP theory is to argue that the exchange rate will change if a relative price is changed. For example, imagine there is no price inflation in the United States in the imagination, okay? While prices in Japan are increasing by 10% a year. 10% a year. At the beginning of the year, a basket of goods cost is $200 in the United States, and in Japan it is 20,000 yuan. So the dollar by yuan exchange rate according to the PPP theory should be $1 equals to 100 yuan. At the end of the year, the basket of goods still cost is 200 in the United States, but its cost is 20,000 in Japan. 22,000 in Japan. PPP theory predicts that the exchange rate should change as a result. More precisely, by the end of the year, because of the 10% increasing in the Japan prices. Because of 10% inflation, Japan yen has depreciated by 10% against the dollar. $1 will buy 10% more yuan at the end of the year than at the beginning. This is what the relative form of the purchasing par parity is. Thus, the PPP theory predicts that exchange rates are determined by relative prices at the beginning, and that changes in relative prices will result in a change in the exchange at the end of the year. Money supply and price inflation. What is money supply and what is price inflation? In essence, PPP theory predicts that changes in relative prices will result in a change in exchange rate. Theoretically, a country in which price inflation is running wild should expect to see its currency depreciate against that of countries in which inflation rates are lower. If we can predict what a country's future inflation rate is likely to be, We can also predict how the value of its currency relative to other currencies, its exchange rate is likely to change. The growth rate of a country's money supply determines its likely future inflation rate. Thus, in theory, at least we can use information about the growth in money supply to forecast exchange rate movement. Money supply and price inflation. So, now we have a connection between the growth in a country's money supply, price inflation, and exchange rate movement. When the growth in a country's money supply is faster than the growth in its output, price inflation is fueled. The PPP theory tells us that a country with a high inflation rate will see depreciation in its currency exchange rate. Evaluation of the PPP theory. Number one, empirically holds true in long run but not a strong predictor of short-term movement in exchange rate. The second one is better prediction for underdeveloped capital markets but less useful in predicting in case of advanced industrialized nations. The third one is assumes away transportation costs and barriers to trade. The fourth one is the demand is not always identical. Differentiation in product is an important factor leading to price discrimination. Number fifth, government also intervene in foreign exchange market. And the sixth one is impact of investor psychology and other factors in price determination weakens purchasing power parity theory. Interest rate parity IRP theory. IRP theory is a theory that suggests a strong relationship between interest rate and the movement of currency values. It suggests that future exchange rate will be depend upon the differences in interest rate in two countries. Interest rate parity theory implication. Number one, if interest rate parity theory holds, then arbitrage is not possible. No matter whether an investor invests in a domestic current country or foreign country, the rate of return will be the same as if an investor invested in the home country when measured in a domestic currency. The second one is if domestic interest rate are less than foreign interest rate, foreign currency must trade at a forward discount to offset any benefit of higher interest rate in foreign country to prevent arbitrage. And the third implication is if foreign currency does not trade at a forward discount or if the forward discount is not large enough to offset the interest rate advantage of foreign country, arbitrage opportunity exists for domestic investors. Therefore, domestic investors can benefit by investing in the foreign market. So, what is the forward discount rate, or how we calculate the forward discount rate? For this, we use a formula by uh, spot price minus forward price divided by forward price divided by spot price is the formula of the forward discount or the forward premium. If discount if domestic interest rate, the fourth implication is if the domestic interest rate are more than foreign interest rate, foreign currency must trade at forward premium to offset any benefit of higher interest rate in domestic country to prevent arbitrage. If foreign currency does not trade at a forward premium, or if the forward premium is not large enough to offset the interest rate advantage of domestic country, arbitrage opportunity exists for foreign investor. Thus, foreign investor can benefit by investing in the domestic market. Fischer effect. Economic theory tells us that interest rates reflect expectation about likely future inflation rates. In countries where inflation is expected to be high, interest rate also will be high because investors want compensation for the decline in the value of their money. This relationship was first formalized by economist Erwin Fischer and is referred to as the Fischer effect. The Fischer effect states that a country's nominal interest rate is the sum of the required real interest rate and the expected rate of inflation over a period for which the funds are to be lent. More formally, nominal interest rate is equals to R plus I. For example, if real rate of interest in a country is 5% and annual inflation is expected to be 10%, so the nominal interest rate will be 15%. As predicted by the Fischer effect, a strong relationship seems to exist between inflation rates and interest rates. We can take this one step further to consider how it applies in a world of many countries because every country has different constraints about inflation, about rate. So ओवरऑल इसको कैसे हम अप्लाई कर सकते हैं? An unrestricted capital flow when investors are free to transfer capital between countries, real interest rate will be the same in every country. If differences in real interest rate did emerge between countries, arbitrage would soon equalize them. For example, if the real interest rate in Japan was 10% and only 6% in the United States, it would pay investors to borrow money in the United States and invest in Japan to forward for profit maximization. So the resulting increase in the demand for money in the United States would rise and in the real interest rate there, while the increase in the supply of money of foreign money in Japan would lower the real interest rate there. So this would continue until the two sets of real interest rate were equalized. It follows from the Fischer effect that if the real interest rate is the same worldwide, any differences in interest rate between countries reflect different expectation about inflation rate. Thus, if the expected rate of inflation in the United States is greater than the Japan, US nominal interest rate will be greater than Japan nominal interest rate. Because we know from the PPP theory that there is a link, in theories at least, between inflation and exchange rate, and because interest rates reflect expectations about inflation, it follows that there must also be a link between interest rate and exchange rate. This link is also known as international Fisher effect or the international Fischer effect states that for any two countries, the spot exchange rate should change in equal amount but in the opposite direction to the difference in nominal interest rate between the two countries. Stated more formally, the change in the spot exchange rate between the United States and Japan, for example, can be modeled as follows: S1 minus S2 divided by S2 and multiply by 100, or we can say interest of the United States minus interest of the Japan, where IS and ION are the respective nominal interest rate in the United States and Japan. S1 is the spot exchange rate at the beginning of the period, and S2 is the spot exchange rate at the end of the period. If the United States nominal interest rate is higher than Japan, reflecting greater expected inflation rates, the value of the dollar against the yuan should fall by that interest rate differential in the future. So if the interest rate in the United States is 10%, in Japan it is 6%, we would expect that the value of the dollar is depreciated by 4% against the Japan yen. Do interest rate differentials help predict future currencies movement? The evidence is mixed. As in the case of PPP theory, in the long run there seems to be a relationship between interest rate differentials and subsequent changes in spot exchange rates. However, considerable short-run deviation occurs. Like PPP, the international Fischer effect is not a good predictor for short-run in spot exchange rate. Investor psychology and bandwagon effect. According to the number of students, investor psychology and bandwagon effect play an important role in determining short-run exchange rate movement. However, these effects can be hard to predict. Investor psychology can be influenced by political factors and by microeconomic events, such as the investment decisions of individual firms, many of which are only loosely linked to macroeconomic fundamentals such as relative inflation rate. Also, bandwagon effect can be both triggered and exacerbated by the idiosyncratic behavior of politicians. Something like this seems to have occurred in South Asia during 1997, when one after another the currencies of Thailand, Malaysia, South Korea, and Indonesia lost between 50% and 70% of their values against the US dollar in a few months.